We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Andy Hoese, publisher and creator of Finding Value Finance channel. How are you today, Andy?
I'm doing great, and thanks for having me back on, Tom. Really appreciate it.
Always great to have you and great to chat. And I think really interesting to be able to have a conversation with somebody that really tries to, be that guy outside the system, outside the herd, let's say, as we were talking a little bit before here, that really tries to look at the evidence for, any of these different cycle components. But I was thinking we could kind of start today's conversation by talking a little bit about, let's say, that 5,000 foot view that you have of what is really going to drive these markets going forward, whether that's, commodities, whether it's the stock market, the bond market, everything, ends up being kind of underpinned by this current as you see it. So why don't we start there and then we can dig into specific markets from there.
Sure. So my high-level view of everything, it basically deals with the market conditions that forces people to behave a certain way. So if you subject people to a low inflationary environment versus a high inflationary environment, they behave differently under those market conditions. So what I see going forward from 2020 onward is an increased inflationary environment. When looking backwards, those environments were created by real estate lending, residential real estate lending into the system, because the majority of that lending comes from residential real estate. And right now, we've got the millennials coming into home buying years. They are looking for homes, and there's a large deficit of homes in relationship to this millennial demographic. You can look at different statistics. The gap that people estimate this to be is somewhere between 3 million and 7 million homes deficit between household formations and the actual supply of the homes. So historically, when you get these large booms in real estate and in a fractional reserve lending system, you get a lot of inflation because that credit is being created by the commercial banking system. So that commercial lending from the banks creates inflation. That inflation comes into the system, and then it causes havoc on the bond market. Interest rates will start to rise because as inflation goes up, and that could kick off a debt crisis, a problem if interest rates go too high. So to me, the 5,000 foot view is the pressures being applied by the demographic through the real estate market, which then has tertiary effects in the system. The way that Powell slows this thing down, in my opinion, is by raising interest rates and trying to raise those rates to a level that is unaffordable for a lot of these millennials to buy homes. So he can slow it down, but in the process of slowing the inflation down through the affordability, he puts a lot of pressure on the government and the debt in the system, because the interest rates, as they go up, it's going to have an impact on the interest rates or the interest expense due to those interest rates. So you kind of get inflation from either end. You get it from government spending and interest payments, stuff on that end. Or if the interest rate's too low, he gets the inflation from the bank lending in the commercial banking system, which historically was the driver of inflation. So there is one thing where we could get a slowdown in the short term. The way I see that and the possibility of that occurs when we have real estate that's in this cycle and they have deficits in the real estate market, but they also did a lot of stimulus in 2020. So the inflation that we got is a component of the real estate market and the bank lending and the commercial banking system, and a component of the stimulus that they sent into the system in 2020. So your interest rate and where it's driven upward because of that inflation is a component of bank lending and a component of stimulus. And what I don't know, and I don't think anyone really knows this, is what amount of inflation is contributed to the stimulus versus the bank lending, because there's a lot of bank lending that occurred during that time frame. And I think it's probably a good chunk was due to stimulus, which means we could have, quote, a stimulus overhang or a hangover of stimulus behind this stimulus, not being injected anymore. Mm-hmm. So whatever they do, we could get a slowdown in the short term, definitely possible. And I don't know what that looks like. I can't tell you if the rates are high enough to kill the real estate market completely. It sure looks like that's the case. And maybe rates have to come back down, and maybe they won't lower rates until liquidity dries up. We get a slowdown in the market, and then the rates come back down right into the affordability of a whole bunch of people in the millennial demographic wanting to buy homes, which then kicks off another wave of inflation. So I know the demographics there. We know, at least I think I know, that there's a deficit in the housing market. Some people can debate that. Mm-hmm. And if that is there, I'm going to remain long on the inflationary trades. Mm-hmm. So that's kind of my big view of all this. The demographic came in, it caused inflation. It may cause other problems in terms of interest payments and all that on the government debt. And all these tertiary effects in the system. I don't think we're going to get a deleveraging crisis or event where credit gets massively destroyed from the real estate market like 2008, like the mid-1970s, like 1980, like 1929. Those were all deleveraging events. So I know a lot of people compare it to those times. I just don't see it the same way, because those were all real estate crashes and credit deleveraging events. Mm-hmm.
Andy, it's interesting to consider the 70s. Of course, that was a time of, higher highs in inflation, this very cyclical stepping up of inflation, as well as an explanation that you gave me. I believe it was the last time we spoke. And this explanation of the demographics really killing inflation and not necessarily Volcker having the effect that everybody gives him credit for at that time. So is that in some ways, is it a good proxy for the way you see this cycle evolving now?
Well, the cycle coming forward, it's going to be an interesting cycle. I think it's going to be bigger than a lot of previous cycles. The reason I think that might be the case is we've got bank lending that is expanding, or was expanding. It's definitely slowed down due to interest rates, but that was much like the 1970s. Mm-hmm. Bank lending and that inflation, the source of it, at least in my opinion, is from bank lending. Now we've got potential bank lending, and we've got deficit spending, interest payments, that, the interest expense ballooning. We've got kind of these things happening simultaneously. Then on the supply side, I think it's getting harder to increase supply to meet the increases of money growth. Inflation, more or less, is just money growth divided by GDP, and that's kind of your inflation. So if GDP is constrained on the supply side of commodities, then what's going to happen is you're going to get a larger imbalance between money creation and the supply of commodities to create GDP. So that imbalance, I think, is going to be harder to keep in balance, GDP and your M2 money supply or credit creation. I think that's going to be hard to keep in balance, to keep inflation at a, quote, acceptable level from the supply side of commodities. So the way that I see this is in the 1970s, what occurred was credit was created faster than the supply response could respond to. And the inflation is that difference. So credit was coming into the system at a faster rate than supply could respond. That is what inflation really is. What I'm saying is the supply side's constrained, and we have a lot of people wanting to create credit on the demand side. They can squash down credit with higher interest rates from the residential loaning construction process, but that might put fiscal spending at a much higher rate. So I don't know how they get out of inflation going forward if you've got this imbalance in the system as large as it is and the demographic coming through these home buying years. So I think, I mean, this might last 5-10 years, and I don't know what that does to the interest payments and the debt. Because if they try to squash that inflation, they're just gonna create another problem somewhere else.
Mm-hmm.
So I think it's going to be more intense than the 1970s because there's more supply constraints, and I think that they're worse off with the demand side, and there's going to be this large imbalance between credit creation or money creation and GDP. So the imbalances could be very, very large, which indicate very large inflation.
Mm-hmm. Andy, as we think about let's say the constraints on credit creation and really lending standards right now, it seems that banks are really tightening their lending standards. Does that, in your opinion, just come back, in a way, the floodgates open back up for credit expansion once rates come back down?
Yeah. So right now, I think Powell, these big crashes, I'll start there. These big crashes generally come from forced selling. Forced selling is where you get foreclosures, you get bankruptcies, you get whatever, and people are forced to sell something. I don't see a lot of foreclosures or distress selling coming from the residential real estate market or anything like that. Maybe it comes from commercial, but that's really insignificant for bank lending when compared to residential real estate. So I don't see forced selling. And we could get a slowdown or recession in the short term with maybe it's lending in the auto vehicles, like the automotive markets. There's a lot of lending there that's probably might get some forced selling. Maybe it's small businesses now that we've got higher rates, maybe something occurs there, but I don't think it's going to be like a blowout slowdown recession. So we could get a slowdown, we could get a recession technically, and then you lower those interest rates. And that's what causes another wave of inflation. It would be from bank lending and a decline of interest rates. If we don't get a strong enough pullback, if we don't get a strong enough I'll say like deleveraging problem in the market, wherever it's going to occur, then rates might not come back down. There might not be a scare into bonds where people run or flood into the bond market, lowering those interest rates. We might be higher for a lot longer and they never actually come back down. So, I know a lot of people they're confident that this huge recession is going to come and it's going to be like 2008. They're confident that a slowdown will definitely come. All I'm going to say is I don't know how this will necessarily play out in the short term, because you're going to have this deficit spending that is occurring at the same time that you can get a slowdown in bank lending, and that may overwhelm the slowdown in bank lending and credit creation on that side. So this will overwhelm. This is the fiscal side going up. It may overwhelm it. And we don't see a nominal crash in the markets. Nominal being, you actually have prices go down. So you can have GDP contract a little bit, but in nominal prices, because inflation is so great, it may not go down like most people think, like 2008 or some of these other recessions. We could be in a recession where the prices go up. So I'm not convinced that we're going to get this big sell-off that people think we're going to get. I'm not convinced that home prices are going to go down like 30% that some people talk about on YouTube. I know fear sells. And I guess I'm not in the fear camp, and I don't want to mislead anybody and try to just get views based off fear.
Mm-hmm.
So what I'll say is the short term, I think, is really difficult to predict. And I don't know if anyone's going to nail this thing in the short term. There's a lot of inflationary kind of pushes that are coming into the system. And there's also at the same time some things that need to get destroyed. And I don't know which one's going to win in the short term here. Longer term, when those imbalances are corrected, I think we're going to go into an inflationary period for probably at least another 5 to 10 years, is my guess, somewhere in that range, maybe a little less, 3 to 8 or whatever, because of the situation that we're in with the demographics, the deficits in the housing market, et cetera, and then the fiscal problems that we have.
Mm-hmm. As you're explaining that, you said some things need to get destroyed. What would those be, Andy?
Well, so we've held interest rates down for a very long time. And there's a lot of companies, a lot of businesses that I'll say only survived based off of the interest rates being that low. But when rates go up, that may change their balance sheets dramatically. They may be companies that aren't really making money. And then when you raise rates and you get inflation into the system, there's going to be different pressures that are applied to businesses in the markets. They're not used to 5, 6, 7%, 8% interest rates that they have to pay. They may not be sustainable with those rates. Another thing is the habits that the herd, the humans in the system, they're gonna spend less on certain items, and they're going to spend more on other items. Their cost of living will increase. They might spend more on energy. They might spend more on food, and then they have to cut out whatever other things. So as the rates go up, the businesses and the people within the system are going to start to behave differently, and money's going to start to flow differently in the markets. And I think some companies are going to have to either contract, or they may go bankrupt, or they have to go out of business. And that transition process between low inflation, low interest rates, and high inflation and high interest rates is going to cause friction as that moves. So I don't know exactly which companies necessarily are going to get hit. I don't know exactly how this will play out in the short term, but I do think that there's going to be potential slowdowns in certain sectors, and things are going to rotate differently than what we saw, historically. And the money's going to shift and move where people are going to have to spend it versus where they might want to spend it. And that's generally where the technology sector and some of these other sectors may get hit. So if you were to look and just kind of look around, generally in this low inflation to high inflation environment, you're going to see companies that were highly valued in a low interest rate environment, their valuations are going to completely change in a high interest rate environment. And that may impact the business enough where they're like, we got to cut this, or we're going to change the business completely. So that transition is where I see a potential slowdown in the markets. And if rates stay high for longer, this could take some time in the short term here to kind of flush this stuff out of the system.
Mm-hmm. When we think about the absolute level, let's say, of interest rates and the value of the bonds associated with that, is it possible that this higher for longer period creates enough demand in bonds to really stamp out the demand for, let's say, precious metals? Or is that more so just a matter of time before you see that dynamic reversing and coming back into that inflationary cycle?
Yeah, so the past 40 years, as interest rates have gone up, gold would generally go down. And gold does really well on the later stage of the business cycle, real estate cycle. So I interchangeably use that. The real estate cycle is the business cycle. When you get to the later stages of a business cycle or a real estate cycle, which I don't think we're in that yet, that's generally when gold does really well, is towards the later end of those cycles. as we kind of roll over. And maybe we are at that point and we have to cycle back down before we go back up and do another wave of inflation and another big move in real estate and stuff like that. But gold generally does really well when the yield curve uninverts. So we're inverted and it's staying inverted right now. Gold has moved above a bunch of different, key support resistance levels. Like we're sitting on top of things ready to hopefully launch at some point. And generally gold does very well when the yield curve uninverts. So what does that mean? It means that there's a slowdown in the market that's coming. And that's what makes this really difficult to nail here, because you've got gold sitting on top of all of these support levels, ready to basically take off, in my opinion. And maybe that is another indicator that we get a slowdown in the market, because that's generally when it takes off. If you look at when gold did really well, and historically, at least in recent times, it's when the markets had slowed down and they did more stimulative measures. So markets would slow down, the physical gold price would go up, they would stimulate the market, and then gold really took off. And then it would go sideways as that stimulative credit creation process kind of works its way through the system. There's also another condition that gold does really well in, and that is when people worry about currencies and bonds. So I think that's another condition where we could enter. Well, let's say we don't get a slowdown, interest rates start rocketing, say past 5% yields, and we just keep going. Gold could start to take off because people start to worry about the bond market, and then they start to worry about the currency market, because more than likely governments save their bond markets and they put that pressure on the currencies. Mm-hmm. So I think gold would do very well because of the lack of investments for people to go into. As rates go up, obviously bond markets sell off. The 20-year bond market, TLT, ETF, if you want to look at that, that's gone down massively, like 80% decline or something like that. So people don't want to put money there. And then they don't want to put it in the stock market necessarily if rates continue to go up, because growth is discounted at a higher interest rate for net present value calculations, which means that the valuations in relationship to the interest rate should go down. So if money doesn't want to go into bonds and money doesn't want to go into stocks, well, what are you left with? You're left with, I don't want to take a bunch of risk. Then people generally choose gold. Even if the rates are high, if rates continue to go up, that means that your bond prices will continue to go down and people are less willing to put money into it. So I think gold will do well if rates continue to go up. They go up to a certain level where people get scared of the currency or the bond market. I think money is going to rotate into it. It's going to rotate into commodities. It's going to rotate into precious metals, just in general. And the drivers of that is the demographic coming into home buying years, and then that's going to kick off maybe a debt problem or a debt crisis, and that's when gold will go berserk if people get afraid of that. At this time, I don't know if that's necessarily impacting yet. I don't know if people are worried enough yet, and I think it will be at some point. What I generally like to say is, it's better to panic first and get there first and get a position before everyone else starts to panic. So it's hard to position based off of seeing a price move up and then getting confirmation from price movements. So you really want to focus on, in my opinion, chart patterns, what the herd is kind of laying down in terms of psychological chart patterns. And if you've got a good entry point and something's cheap, I just position and take it. And then you have to take a stance on what you think the future will be. If you think we're going to potentially have a debt crisis, or if you think we are going to have high rates of inflation due to credit creation in the real estate market, that's how I would position is precious metals and commodities and stuff like that. Other people disagree with my opinion. They think that we were going to get a big, huge crash and that the whole markets are going to go down. If you hold that viewpoint, well, then you should be in bonds, because long duration bonds and gold would do very well under that condition. But I just described two conditions for gold that works under in an inflationary environment and a slowdown.
Mhm.
So I think gold is a pretty good spot to be, especially where it's located, where it's on top of all these support and resistance lines. It's all above it. That looks ready to take off, and I think it'll do well in either of those conditions, which both of them could occur here in the short term.
Andy, it makes me wonder, let's say, how you see the longer term prospects for the dollar. As you said, it depends on which case we get, whether you end up sacrificing the currency to support the bond market. So how do you see the prospects or the value of the dollar going forward?
Gonna get smoked. It's gonna get smoked. The demographics there to buy these homes, that's generally ended with an inflationary deal. It generally increases interest rates, and we're going to have interest rates at a higher level for longer. And then if we get into a bond market problem, they're going to smoke the currency.
Mhm.
They've done that almost every time. There's no other option. You're not going to let it default. So I think the pressure is going to build in the currencies over if you take a longer term time frame, you don't focus on the very short term. I think the dollar will get hit at some point, and that dollar will get hit. At least historically, what happens is the pressure kind of gets relieved in the dollar when the interest rates go back down. So we could have this big inflationary impulse, rates just rocket on up. If rates go up faster than other currencies' rates, generally the dollar remains stronger because they're going to just continue to increase the rates at a faster pace than what the rates are in other currencies that it's being compared to. And I'm talking about the DXY.
Mhm.
The value of the dollar in absolute terms will continue to go down, but it'll look like it's getting stronger against other currencies as long as interest rates continue to go up. But if we get a slowdown in the market, that's generally when the dollar will fall, when rates go sideways, or if it goes down and other currencies rates are going up or have already crashed and are starting to stabilize. At least that's my opinions around it. So I think longer term, with the demographic and what we've seen in history, dollar's going to go down in absolute terms. So that's what I think.
Andy, it's been said often that to get this, let's say, this rotation of capital into the commodity markets, bigger institutional investors have to see this outperformance of the metals, of the miners, energy producers, sectors like that. So do you see that as part of, let's say, the recognition and that wave of rotation of the rest of the herd, as you called it, coming back into commodities and the producers?
I think the lack of viable investments is what causes people to take action. So if they're sitting over in the bond market and they just lost a boatload of money, I think that's going to create action. If they're sitting in stocks and the stock market goes sideways or starts to go lower, that could create action for them to say, you know what, I think we need to go into something that's outperforming. So I think the lack of potential investments paired with losses that they physically have to endure or go under, it's in their accounts, they see it, it's going to cause that rotation. And I think the rotation has already occurred, starting to occur with the bond market selling off as much as it has. And with the bond market selling off as much as it has, I think people are going to start to question bond holdings.
Mm-hmm.
Then, if interest rates continue to stay higher for longer, and these interest rates are definitely not priced into the stock market and NASDAQ yet, I don't think. I think that could cause a rotation there too. So if we see pressure of sideways movement in the NASDAQ and S&P over a long period of time, we see the bond market continuing to go lower because of the increasing interest rates and the unwillingness for people to buy bonds. Plus, the supply side of bonds is dramatic. They're rolling over a lot of bonds on the bond side, and they're releasing new bonds on top of it. So they're flooding the supply of it. That's going to say, people are going to say, where am I going to put money? Mm-hmm. If I'm going to get killed over here, where am I going to put it? And that's where it's going to lead into commodities and precious metals, because that's where the outperformance is under these types of market conditions. It just takes a long time. It's not fast. We're coming off a 40-year decline in interest rates, and the go-to areas have been bonds and stocks. And that is ingrained into people for 40 years. And for them to change their mind, a lot of people are going to say, you know what, I made a lot of money in the S&P 500. I made a lot of money in these stocks that have made money for me 20, 30, 40 years. So the psychological stranglehold on these people is ultra strong. Like, that's how they made their money, and they're used to making money in bonds and stocks. And in my opinion, they're going to have to get slaughtered for them to change that mindset. And it's going to take 3, 4, 5, 6 years for that to occur. Mm-hmm. It's going to take some time. And when that does occur, and they start to see the outperformance, because remember that these markets are very big, the bond market and stock market, in relationship to the precious metals market and also a lot of these commodity markets. When they start to see these things go up, they're going to FOMO in. They're going to FOMO in like they've never done before, because their assets that they've got and their investments aren't working for them. And when they start to see that outperformance in whatever these sectors are, I think you're going to see a large outperformance of commodities, like a very large outperformance. And it could happen very fast, because the markets are so small in relationship to how big these other markets is. And if you just get a slice of it to go over, just a teeny slice, it's going to have a big impact on the pricing of those commodities. So I remain incredibly positive on commodities and precious metals, even if we get a slowdown in the short term.
Mm-hmm. Yeah, I think that recency bias is a major factor and major headwind for a lot of people to kind of change their mind about, exactly as you said, what has worked for the last 40 years. But another piece that you mentioned there was let's say the concept of timelines and how you really set the expectation for yourself or for your, let's say, your favored asset at that time based on what you see as a proper timeline. So how do you go about trying to really conceptualize that for yourself, of what timeline you expect or that you're okay with being in a particular position from?
Well, I take a longer term time frame. In the 1960s, the commodity to stock ratio stayed low for, it was 5, 6, 7, 8 years. It stayed low, and it didn't come up till the 70s. And same with some of these other, I think, setups that we've got today. It could stay low for a while, based off of what I was just talking about with the mindsets that people have, and the unwillingness to change that mindset. So I think you have to have good conviction of what you're investing in. Of a lot of people call it the thesis being the real estate market and the imbalances in the market. I think you have to know that stuff, and that you have to be a believer that inflation is coming. If you take that stance, I think you need to take a time frame that is longer, 5, 6, 7, 8, 9 years, 10 years. And I don't think it'll take that long to play out. I think that's the entire cycle will play out in that time frame. So we'll start to come up at some point. But in the short term, we could look very wrong, because if we get a slowdown from the interest rates coming up and this stuff has to basically get cleansed out of the system, it's possible we get a slowdown and everyone's going to be cheering that the old mindset's going to work again. And what that really is it's just going to be one gigantic bull trap for all these people. And it's going to be a bear trap for the commodity people. All the bears are going to get sucked in. All the bulls will get sucked into the other ones. and then they're just going to get ripped, in my opinion. So I think you have to have a time frame that is longer than the potential slowdown that we could get in the short term, if there is one. And you have to get it out maybe at least 3, 4, 5 years for this to occur. And I think a lot of sectors are going to go up before that. Sectors like uranium, just because the supply sides are so jacked up. So yes, there can be a slowdown. Yes, you need a time frame that can go long. I'm not convinced that it's 100% in the bag. I'll just say if it does come. And if you take a time frame that's longer than that, I think you'll be all right. And you have to take a mindset that inflation will eventually win out in the end. That all roads kind of lead to inflation. I know it's kind of a Peter Schiff quote there, but I do think that will eventually occur from the real estate market and or the fiscal, government spending, interest payment, interest debt, all that stuff. So if you take that mindset, you take a long enough time frame, I think people are going to be rewarded massively because the commodity to stock ratio, we're coming off all-time lows. We can go back 100 years. We're lower than 100 years. Money's all went into financial assets with the lowering of interest rates the past 40 years. And in my opinion, if that all unravels and rotates back with interest rates going up, being the driver of it, commodities are going to do some crazy stuff. It's just a matter of being patient in a waiting game. And really what it comes down to is you're going to be your own worst enemy is going to be yourself, because you'll probably doubt that inflation will come if we get a slowdown. You're going to doubt it. You're going to try to jump back in with the herd, thinking that the old paradigm is back. I just don't think so. I think we're going to continue to have inflation. I think the demographic will drive it for a period of time. I think the real estate market is going to drive it if it doesn't come from the fiscal side. And that's kind of where my thoughts are at. Longer time frame.
So, you mentioned uranium in there, and obviously I know you're very bullish on uranium. Are let's say the particular sectors that you're most bullish on all have this supply deficit, high demand type of dynamic really entrenched within them?
I am the most bullish on inflation sensitive assets. So if you look at history and you were to yank up a chart and look at what is very inflation rate sensitive, what that would show you is, oil, natural gas, uranium. You can go and look at the metals. Some of the metals are very inflation sensitive, like platinum, silver. They might be a little bit behind the other ones, but energy in general, huge bull. You could even be bullish on home builders. You could even be bullish on banks. I know that sounds weird, but banks make more money in a higher interest rate environment. And if they continue to lend more against all these new homes that are going to have to be created, they're going to expand their loan book. It will be expansionary. So, but again, I don't know if that, I'm going to get killed for saying that, because they're going to say, oh, we're definitely getting a crash. It's just a matter of time. The whole housing market's going to collapse. I'll just say, I don't know how it's going to collapse into a bunch of millennials that all want to buy homes. They just can't afford it yet. They're all underneath this market. If rates come down into that volume of home buyers, sales I think are going to come way back up. So the only way you can get a crash, well, in my opinion, is if they hold those rates on up. But my whole thesis is I think inflation's coming. I think it's going to be bad. And I'm in a lot of inflation sensitive assets. And if you were to look at some charts, and maybe I can pull a couple of charts up, get you guys really confused. I'll pull something up here. This is the PPI to CPI ratio, which is a very interesting chart here. And this, I'm using TradingView. I know some people have questions, but this is the producer price index divided by the consumer price index. So in an inflationary environment, the producer price index will outpace the consumer price index. So you'll see the ratio go up in an inflationary environment. The CPI is a lagged indicator. The PPI is kind of a leading indicator. That's the way that you want to view it. So as inflation comes, as credit that comes into the system, as it kind of comes through that society or community or whatever, it's going to push the PPI up first, and then get transferred into the CPI where they become more balanced. So a ratio that's moving up means that you're in a highly inflationary environment. And then when it's moving sideways, it means you're in an inflationary environment and the producer price index is going up the same pace as the consumer price index. So this is a highly inflationary environment in the 1970s and all the way to 1981. It's a very high inflationary environment. That occurred under an expansionary phase of real estate, and we had two waves of overbuilding that occurred. We had an overbuilding phase in the middle of the 70s and at the end of the 70s, early 80s. But when I look at this chart, and this is a ratio chart, this to me looks like this is one big double bottom. And we hit resistance. We had a lot of resistance here, either horizontal resistance or this downtrend line that we've got, that we basically smacked our face against. And that's that slowdown that I think we're getting. It's basically the interest rates coming up, the unaffordability, the affordability getting a lot worse, maybe crap coming out of the system. Like we're basically going through it right now. And what I think could occur if this is a double bottom, what you do is you take the projected price move is basically your move here. It's about roughly this, and then you project it upward. It looks like it swapped a little bit. Maybe I was on logarithmic or something. And there's your projected price move, and that puts you back towards the 70s or even towards the top of this. And that's just the projection. It doesn't mean it tops out there. That's just a rough projection. So what this is projecting, if this is a double bottom pattern, is that we could go into a very inflationary environment, and we get another wave that comes. Mm-hmm. So that is something there.
And really driven by producers, right?
It's driven by commodity prices. Mm-hmm. So what occurs is the commodity price goes up, and then the producers will see the inputs of their commodity prices go up. And that's what the producer price index is. It's the producer prices are going up, and it'll feed through the entire supply chains to the end products, which the consumer price index is measuring. So I think we could see a large imbalance where the commodity prices go up dramatically, which then feeds through the whole system. Mm-hmm. And that's kind of what that is measuring and suggesting. Is chart patterns 100% right? I tend to believe that they have a good indication. They might not be 100% right, but on the longer term, they're generally pretty accurate. Mm-hmm. And then if you compare that and find more evidence of what is driving that, I think it makes a stronger case. So the evidence is the millennials, the demographic coming into home buying years. The evidence is this housing real estate market imbalance, which all supports this potential move that could come in this PPI to CPI ratio. And that's where I get my confidence from. It's like, hey, this thing is aligning. You can also look at a lot of the home builders, the big home builders. They're all making almost new all-time highs. In 2005, we had the housing starts roll over in 2005, and all of the home builders were rolling over that same time frame. Right now, we've got housing starts dropping, but all the home builders are going up, and some of them are at all-time highs. The big home builders, like the ones that are the big boys out there, like D.R. Horton, Lennar Corp, and some of those companies. That divergence between the housing starts coming down and the home builders continuing to move up gives me more confidence that we probably are in a very large housing market boom, and that people are not selling those stocks, they're positioning in them. So that gives me more evidence that this could be a very inflationary environment because of that. Even the Fed has come out, Kashkari came out and said, we've got a problem in the housing market, and I think they're trying to squash it. The problem is they can't. There's nothing they can do. They can make the interest rate go up to an unaffordable level, but what's their next plan? They just slow down the market. They get a recession. If they hold it high for too long, things slow down, just like we're describing here. You take a time frame that's longer than that to stay invested in it, then they're going to have to lower interest rates because there's going to be unsurmountable pressure for them to hold rates at that exact level that is killing your job creation, that's killing the inflation and all that other stuff. So at some point, they're going to have to lower the interest rate if it does kill the market. So if it lowers the interest rate, now you're back into the home buyers, the millennials with all these home buyers that are going to have to build a bunch of new homes to basically refill our inventory levels, which are at incredibly low levels. So I view it as the inflation will come. It's just a matter of when, is the way I view it.
Getting back to the uranium market as you see it, what part of the cycle are we in for the uranium market in particular here?
Oh, we're like barely warming up. The equities haven't moved against the futures pricing, and I can show you that here as well. And I don't want to get people too bullish, but so here's URA. I'm using URA only because URA has a lot more data, and I've got some stuff written there. Here, I'll delete this out real quick. But we are at a incredible. So the moment. Think of momentum. Momentum's coming down. Generally, you get a large momentum move to the downside. Then you generally put in a basing period. This is the basing period that we are in. And then eventually, when you're done with the basing period, you're going to move on up. If you look at where we're at in this ratio, and what we're pricing is the URA ETF divided by the futures pricing of uranium, the equities themselves haven't even moved off of the bottom against the futures pricing of uranium. What I would view this as is people don't believe that the uranium bull market's even underway. I don't even think they believe it. And if people think that this big uranium bull market will eventually come, well, they should be positioning in this. And they haven't even moved yet. The actual equities haven't. I'm sure some people might ask, well, maybe the futures pricing is going to go to the moon and the equities, they're not going to follow. I don't believe that. I think when the futures pricing gets out there and we start to move on up, I think the equities will play along with it. I also think that the same thing for gold and silver. We're just that early. Like we are still that early. And a lot of the patterns that are being developed in a lot of these different commodities are still in their basing patterns. They haven't broken out of the base of the pattern yet. So generally you get a large downward move, big selling pressure. It usually occurs under a low inflation, low interest rate environment. You get a basing pattern where those conditions start to change. You get an inflationary impulse move higher. You get increasing interest rates. People say, what the heck is going on? And then eventually when they figure out what's going on, the money starts to move differently. And that money is going to start to rotate in commodities. And what I'm saying is we're not even out of the basing patterns for a lot of these commodity companies yet. Some have broken. And they're moving. The leaders have broken, like Cameco. That's broken out of its basing pattern. It's starting to move. I think it's just a matter of time for the developers and explorers and all that stuff. It may take a few years even for these to really take off out into the future. And the same goes for all these other commodity stocks as well. So you look at oil. Oil's still putting in inverted head and shoulders. We're making the right shoulder right now up against a lot of the necklines. It's just going to take time. And when they do break and it becomes glaringly obvious, then everyone's going to pile into it. And that's when you have to be already invested, is when it's not glaringly obvious, when it's a stealth bull market, when people are disinterested in it. I know people are probably looking at the uranium exploration companies. They're saying these aren't moving. And then they're looking at Cameco and that's moving. So what are they going to do? They're going to go buy Cameco because they're going to chase the return. That's just the way that people are wired. If something goes by and it's shiny, they go and investigate it. They're like, oh, look, it's a shiny object. Or a noise that occurs. Oh, let's go check it out. There was a noise over there. It's the same thing with price. Price goes up. Oh, let's go check out that price. It looks like it's jumped 20, 30%. And then they go chase the price performance. What I'm telling you here is, in commodities, the way that these things are valued are ridiculous. And all you have to do, in my opinion, is you have to take a long enough time frame for these things to play out, and that's how you make all the money. People are going to probably look back and say, how did people buy the bottom of the uranium market? How did people buy the bottom of the oil market? Well, they did it when everyone else wasn't looking. They did it when everyone was fearful. And they did it at a time where you couldn't be a part of the herd. You have to buy this stuff when everybody's telling you it's the worst investment in the world. And you have to continue to hold through it as people tell you that you're stupid for owning it. Mm-hmm. So it doesn't feel good when your investment doesn't go anywhere. And I understand that, but that's how you make the money. Because you buy it, it's going to look like you're wrong in the beginning, because people are going to tell you you're wrong. The price isn't going to go anywhere for a little while. And then when it starts to move, and then it really starts to move, then you say, oh, that's how you're supposed to make a lot of money. Like, just all the light bulbs go off. You're like, wow, that went up 10x, that went up 20x. How did I make so much money? How can I replicate that same strategy over and over again? So I think uranium, the equities are priced ridiculous against the commodity itself. And you could say that with gold. You could say that with silver right now. You can even say that with a lot of the natural gas equities. They're not as priced as well as 2020, but a lot of these equities are still very cheap. And you don't bottom. We're not going to be bottoming in uranium when the equities didn't go anywhere. I mean, or top out. I mean, we're not going to top out in the futures pricing if the equities didn't even move. You can't go through a commodity bull market, be in a bubble, if all your equities are priced at basically nothing in relationship to your commodity, futures pricing. So we're nowhere near a top, in my opinion. We haven't even moved into the commodity bull market with any degree of optimism. I think we're still in the disbelief phase. I think people are not believing the move, and that's why these equities are priced where they're at.
I was going to say, if you think that same explanation fits for the gap between the gold price and the gold miners, the value of the miners.
Totally. Totally. It's the same thing. But keep in mind, though, some of these companies aren't making money. Like, they are not making money where the price of gold and silver is. So if you think about that, if you take a long-term thought process, like, if you just think about it, hey, these miners, they can't make any money. Well, and you look at the physical metals like silver. I'll use silver as an example. Some of the all-in sustaining costs for a lot of these companies that are producing today, they're in the 20s. Some of them are in the high 20s. And you're like, well, the price is in the low 20s here, low to mid 20s. What risk do I have to buy the physical metal? And the metal has to go higher to get above the cost curve of some of these companies so they can actually produce and make a profit, to get more supply of silver to come online, et cetera, et cetera. So I look at it and I think about it. I'm like, well, the physical pricing, it's below the cost curves of some of these producers. Mm-hmm. Well, now it's just a matter of time. How much time can you sit in the physical metal for it to go up? You will go up. The question is, well, how much? And generally what occurs is the physical metals bounce below the cost curves of the higher cost producers, and then they go to some ridiculous level as it goes into some gigantic bull market where you get gigantic margin increase. So the way that I view it is, the physical metals are below some of the cost curves. They're dirt cheap. I'm going to get a bunch of that because that seems like a for sure bet to me if you can hold long enough. Then the mining companies, I would wait until maybe the prices start to move on up. They're based off of margins. They're not based off of the price of the metal completely. They want to see margin expansion between their inflationary input costs and then the metal that's being sold on the back end. As margins increase, that's when their earnings per share go up. That's when they start to really take off. And I think people are just absolutely sick of the sector. I think they're selling it. They're chasing other sectors and commodities right now at the moment, probably uranium, probably oil and energy. But eventually, when the cycle slows down in the real estate cycle and it starts to turn back over, I think that the gold and silver mining companies at some point are going to absolutely kill it. Mm-hmm. I just don't know if we're completely right yet because their margins are getting hit. We've got inflation and we've got the price of gold and silver kind of just sitting there going sideways. So they're getting inflationary pressure as the price goes sideways in a lot of these mining companies. So short term, think pain. Long term, at some point, these are going to absolutely rip it because we've got the market conditions for gold and silver, I think, to go higher. Mm-hmm. It's just a matter of when. And that's you just have to be patient, mm-hmm. unfortunately. And I would buy into strength. I'd wait until these things start to move on up, break some of their patterns, their bottoming patterns or downtrend lines. Then I would start to really pile in as strength is being shown in the physical metals themselves. So that's the way that I would play it. And I would if you want to try to catch bottoms, I just wouldn't do it with all my money. I'd take tranches. I'd buy kind of, I call it sprinkling in, sprinkle some money in, buy. And then as it starts to break out of things, then it's like it's game on. I'm going to start adding significant size to the positions, mm-hmm. is the way I would do it.
And you brought up the oil and gas producers. And at this point, a decent amount of them are also very unloved. So do you focus on dividend yielding stocks at this point? Or does that come into your framework of the companies that are attractive to you?
I do both. I do both. I go and swing for the fence with some of my money on some of these high cost producers up in Canada, which I think still has exportable capacity. I go into those. And then I also look at high dividend paying companies where I can get paid to sit. They might be lower cost, mid cost producers, and I can sit in them and get a big fat dividend yield. So I have the combination of both of them. I've got I call them the high flyers up in Canada, some of them where they're high cost kind of swing producers. And if the price goes to some ridiculous level, which I think it will, levels that people would call me probably stupid, but I think it's going to go way higher. And I think we're going to get massive margin expansion for these high cost producers. Their earnings per share are going to blow out. And I want some money in it. In the meantime, I'm also loading into a bunch of these dividend paying companies across the board, fertilizer companies, energy, nat gas, whatever there is. And there's dividends from 5 to 25%, depending on what you're looking at. Even in some of these diversified mining companies too. So as I wait, I can create a portfolio that's just paying me to wait. And if you want more income that is indexed to inflation, these dividend payers generally pay a percentage of their cash flow. So if you pay a percentage of your cash flow, that's indexed to their cash flow. So your dividends are going to go up and down based off of their cash flows. But if we get a big move in commodities, you're going to get a big move in your dividend, which is absolutely fantastic in my opinion. And I'm glad they set it up that way. So, if I think oil is going 150, 200, 250, 300 or above, depending on what the inflation is in the system, because again, it's the dollar getting devalued, not the supply demand necessarily. The demand is the credit creation. The supply, I think, is going to be relatively stable. So it's credit creation and dollar weakness is where I think that price will get up there, just to explain it. So I'm not super crazy. And then these dividend yields are all indexed to that. So it's like, man, I can double, triple, quadruple my dividend yield if I'm in this and this inflationary outcome comes. If the inflationary outcome doesn't come and oil prices stay relatively where they're at, which I think is close to the break-even point, which is around $80, $90, $100, that's the break-even for where I think oil has to be. That's where the cost curves are at. Then I can sit and get paid a 20, 25% dividend yield, have it go nowhere for a period of time. I'm still getting paid roughly that. And then I've got all this upside potential, both with price appreciation and dividend appreciation. That could also be true for copper companies and some of these other companies. You really need to get a massive downside blowdown move for someone to really, get scared out of it. But I think if you can take a time frame that's longer than this short-term potential slowdown, if we get one, I think you'll just ride through a dip if you can make it to the other side. So dividend payers can be a portion of your return could be from dividends that keeps you in these companies and can ride through whatever volatility or short-term weakness we do see if it does come. I say if. That weakness might come behind it. I'm not convinced that we're going to 100% go into any sort of gigantic recession. We could have a slowdown that we're going through today, and all these rip it, some months out. But again, I might be too optimistic. I understand that. But I, in order for me to be in these positions and to hold these positions, I'm going to have to be optimistic. I can't play this bull market with a negative mindset. You just can't. You can't be pessimistic on your investments at the same time you hold them. You have to be optimistic on them, and you have to think that there's going to be inflation out in the future. So that's my viewpoint. I think we're getting inflation either way, and dividends is a huge portion of a way to play that. And I do play it with a lot of dividend-paying commodity companies.
How do you see the dynamics of the SPR releases over the last year and a half, 2 years, versus the OPEC cuts and their efforts to support the oil price? How do you see those two, really countervailing forces right now?
Yeah, I think the government used the SPR basically to tamper down the consumer price index. And they're also doing quantitative tightening. They're doing all these things to basically hide the mistakes that they created, because we were just going to get smoked with inflation. And I think it might work in the short term. I think OPEC is trying to stabilize the oil price, which is good for consumers, bad for investors, because you want the volatility. You want it to come down, buy a bunch of cheap shares. You want everybody to pull back on production, and that's going to create a super spike in oil if they don't pull back on production. So I think OPEC is right. I think that they're trying to stabilize the market at some point during, maybe there's a perceived slowdown, but the demand is not telling us that there's an actual slowdown in demand of oil. So the SPR, I think, was just a temporary release to slow inflation for a period of time. OPEC's, I think, gathering it up right now as we do QT. And then I think at some point when if a slowdown does occur, we get the slowdown, they lower interest rates, credit comes into the system, and now we're back to an inflationary wave again. Mm-hmm. I don't know when they're going to do a slowdown in interest rates, or if they're going to continue higher. The short term is really murky. Like I can't read it. There's positive signals, there's negative signals. I don't know which signal is going to win which. We've got total construction spending continue to go up, all those things. So the short term is a tough one. I really think it's a tough call, and I don't know which way it's going to go.
Well, I appreciate that humility on the short term, because I think there are so many of these countervailing forces that are at play right now. But, I also appreciate the discussion that we had about timelines. Andy, as we kind of wrap up here, is there anything else on your mind that you think that investors really need to focus on right now?
I think there's a couple of things that I think investors really need to focus on. I think time frame, you got to think longer than just the short term. I think you need to focus on what is driving the inflation. If you're in the inflation camp, what's going to drive it? And in the short term, is the short term going to impact the long-term drivers of that inflation? If it doesn't, in my opinion, just ride through it. Mm-hmm. And I know that takes a lot of emotional strength, psychological balance, et cetera, et cetera. If you're a believer in the bull market of commodities, and you're a believer in the bull market of whatever sector you're in, take a positive, optimistic outlook on the sector. You cannot play this being a pessimistic outlook. If you think everything's going to crash and everything's going to cave in and the world's going to end, I don't think you can hold on. Mm-hmm. Build conviction for what you own. Conviction is everything. You should know the companies to some degree that you own. You shouldn't know nothing about them. You don't need to know everything, but you should know a good chunk. Where are they located? What's their roughly what's their break-even point if it's a commodity producer? And then look at it. Are they going to grow into the future? There's some setups where they've got low-cost production, mid-cost production, higher stuff higher cost production coming online that they're going to grow. Those companies, I think, are absolutely going to crush it if they can increase production into what I think will be an increasing price environment. And if you can get a dividend as well on top of it, holy crap. I mean, you're hitting on every cylinder there. You get paid to wait, and they can grow production into the strength of commodity pricing. Another thing is watch your risk reward levels. Don't take on too much risk. You don't have to. This is going to be a big bull market, I think. I think we're really early. When you're early and you get good entry points, buy the good companies. Buy the good companies up. Don't buy these crappy companies that are going to go to zero that need to dilute you to death. Buy a company that's got infrastructure in place that can generate massive cash flow in a higher commodity price environment. That is going to absolutely crush it. A lot of retail investors, and I feel for you retail investors. I'm a retail investor. Watch your risk. Mm-hmm. That's what I'll say. Watch your risk. And what does that mean? Going into a company that has no way to generate cash, very risky. If they have to build the infrastructure, they have to build all this stuff. I'm telling you that the commodity prices are going to go up and that we're probably going to get a lot of inflation. If you have that viewpoint, what do you think the cost of those projects are going to do out in the future? They're going to go way up. So if you have a company that's got infrastructure in place, they just went into production and they can grow their production right into the strength of this commodity bull market, they're going to kill it. They're absolutely going to kill it. So to sum it up, get the right time frame, have an optimistic mindset. We might get a slowdown in the short term, ride through it, in my opinion, and find good risk reward companies. We're still early in this thing, and watch your risk levels. That's what I'll say. Excellent.
Andy, I appreciate you giving us, a different framework in which to think about this time through. There's so many challenges right now to figure out and understand these things. And I think having, an opposing viewpoint, let's say, and a thorough explanation, the way you laid it out is really interesting to consider. Of course, you do a lot of your work on YouTube, the Finding Value Finance YouTube channel, where you release quite a few videos daily, right?
Yeah, a lot of people want me to do daily updates on the markets. They want to see what my opinions are as it goes along. I don't trade or do anything based off the daily market movements, but people want me to do it because I think they like hearing someone talk about it. I used to trade on shorter term timeframes, but now I just do the long term. So I've graduated from shorter term timeframes to longer terms, and that's where I make all the money. It's all on the longer term timeframes. Mm-hmm. But I used to be kind of a trader back in the day, and they like listening to it because maybe they gain entry points or something from it. Mm-hmm. So, yep.
Excellent. And of course, on Twitter at finding_finance, right?
Yes, finding_finance is my Twitter. And then I also have a website too, finding-value.com is my website.
Excellent. Andy, thanks so much for your time today.
Thank you. Thanks for having me on, Tom. Appreciate it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.